about the Solutions Collective and why we're doing it. So when we launched our strategy last year, there was some clear focus, and I think social lending, making up around 43% of the lending in the market, it's a very wide topic in terms of the things that come into social lending. And the team and I suppose it's the bit that touches social enterprises and charities and voluntary and community sector organisations maybe the most, not precluding them from housing or social outcomes contracts. And so the team and I have been working with our colleagues across the investment group and across communications to see how we can bring our respective audiences and insight together. But I suppose what the Solutions Collective is neatly is it's a feedback loop. It allows us to socialise, to talk to you about the things that we're working on. It allows us to hear from you in terms of whether these things are important, where we've got to test things with you, and to hear the things that you're thinking. So this is the reason for having the Solutions Collective. This first one, we're starting off with government guarantees. As I said to Rob and James just in the preamble, I wasn't expecting huge turnout for this. Maybe it doesn't sound that exciting. And I'm sure that when we get to things like catalytic capital, we'll probably have much bigger numbers. But I think it's really important that we definitely have the opportunity to talk about it. And that's the reason we're here today. It also said in the agenda about terms of reference. I have no intention of going over those. I think that's probably just to set out the context and the intention. And if you want a little bit more and the housekeeping, what we're thinking, then we'll make sure that we post that document in the chat and also that we publish it on our webpage. There is actually a Solutions Collective page now, and you can check that out for future topics for Solutions Collective. Also, if you have a topic that you think we should be talking about in the social lending space, then again, we really want to hear from you because we want to make sure that the conversation is useful. I'm always conscious of the value of people's time. We can all spend forever on Zoom talking about things, and it has to be useful. I think that's all I want to say. I'm going to introduce the panelists. So I've got my colleague here, James Burrows from Big Society Capital, who leads up our social lending market system. And he's going to be giving you some context about what guarantees are, how they fit within our strategy and where we're up to working with them. And then always like to big up the main event. We've got Rob Benfield from Social Investment Business, and he's going to actually talk to you a bit more practically about what guarantees mean in action. I'm going to stop talking now, and I'm going to hand over to James. He's going to go first.
Thanks, Mel, and good afternoon, everybody. It's so nice to see so many of you. I know it's sort of Mel framed it as a small group, but actually it's so nice to see so many people that we've engaged with at different points in time and on many things, as sort of Jed has reflected on already. And I think just the first point, just to echo exactly what Mel said around this being a feedback loop and a developing conversation, really. We know there are things that either we are trying to do that is about supporting other people, but actually we can't do any of it unless it is shaped, it is for, and it has the people who we're trying to work with and alongside at the heart of it. So we see this as a really important part of some of that stuff. So whether there are jumping off points from this, let's keep that conversation going, because we don't have any success unless all of you guys are successful. So that's effectively what we're trying to do. I'm going to talk really briefly under sort of 3 or 4 headings: scene setting, context setting, and we can dive then into each of those in due course if any of them are interesting. But I wanted to get, given basically where people have talked about their interest being, I want to get as quickly as possible into what Rob has to say, where his practical examples and bringing to life where we're up to will be, I think, the most helpful thing for us to spend the most of the time. So please, also, if I do keep going too far into something, give me a nudge. But hopefully, I'll try and keep it. High level. So I'm going to talk about 4 things. One is just general level setting about guarantees. A lot of you will know some of this stuff, and I'll keep this sort of very brief, very high level. But basically, how I think about it, or one way to think about guarantees. I think, secondly, where have they come from in the UK, and where might we go? I think there was a bit of a Cotton Eye Joe song in there somewhere, but that's sort of give a bit of the history and where it's up to. I think the third point is then a little bit how how we think about it in terms of BSC and our social lending work. Mel talked about our strategy and some of that sort of thing, some of the bits around where some of that stuff sits for us and how we're thinking about it. But again, that will then start to get into the practical detail that Rob will pick up on. And then fourthly, and one of the reasons why we've got this session first, Mel talked about it not being the sexiest topic. It's really important that we get your inputs now, because it's at this point in time that the Treasury are consulting on what the next set of guarantees might look like. And so we just wanted to give you a sense of where some of those conversations are up to, and then we'll have some feedback and input on some of that stuff, which I know we've done with some of you already, but just to share this with as wide an audience as possible. So they're the sort of 4 little bits. So I think back to that first point, just around what's a guarantee and how to think about it. And I think about this in a very simple analogy, and it's Jed, you talked about it quite helpfully in terms of subsidy replacement along those sorts of lines. There's a few enabling tools that we have within the current social investment market. One of them is around grant used in different ways, blended finance and inverted commas that we talk about in various ways. The other one is another one that Jed talked about, and there's other types of tax reliefs that exist around some of that stuff. And a third one, which historically we probably haven't used as much in social investment and for the social sector, is this one of guarantees. And I think how I think about guarantees is effectively it's building a bridge, and it's building a bridge between different actors within the sector. So on the one hand, you've got people who have the money, the investors or the asset owners, who are trying to put money out there. You've got on the other side of the river, as it were, you've got social enterprises, charities, social purposes organizations trying to get access to that. And the guarantee effectively helps create that bridge, that two-sided bridge from money into the transaction, and from organizations to get access to the products that hopefully works for them. And so I've heard both of those sides come up a little bit in terms of what people have, and that's effectively how you think about it. And I think one of the things that's particularly helpful is it's a little bit of a it's effectively if an investor sees a transaction and they go, it's got these kind of characteristics and I don't understand it, and therefore it's got this element of risk in it. The guarantee, or the provision of a guarantee tool, and the underwriting of some of that transaction and some of the defaults and the potential for it to go wrong, or the potential risk in that, actually what that allows it to do is to change that dynamic, which effectively is what the bridge is doing. Rob will pick up some of that stuff and bring it to life a lot more in some of the practical examples, but it's that bridge of money across to enterprise that I find really helpful in terms of thinking about it. And it's about another way of sharing that risk fairly and getting those incentives aligned, that hopefully allows more money to flow to good causes, which is effectively what we're trying to do within some of the social investment market and social lending market specifically. So Cotton Eye Joe, where did we come from? Where did we go? So in the UK, we've had a lending guarantee or a loan guarantee scheme of one way, shape or form, roughly since the early 80s. There may have been different times we've had that, but it's been roughly in place. There's been 3 or 4 different iterations and sort of flavors on that in between. I think most recently, Jed again referred to it, that what was called EFG, the Enterprise Finance Guarantee, that came up in the wake of the financial crisis to allow small and medium-sized enterprises in the credit crunch really to get access to this kind of capital when the banks had sort of retreated from some of that space. And I think there you can start to see that bridge happening there already in terms of how that stuff might work and that might come. Now we engage with EFG through, as Victoria talked about, what we call CEF, or the Community Investment Enterprise Facility, which is our CDFI lending facility. We work with 4 CDFIs, and that effectively provides capital to CDFIs to lend into those into the communities that they work in and work in so well. And again, as part of that, there is a CITR top up for some of the match investors alongside us. And I think that was our sort of first foray into understanding and working with this public policy tool. And then what happened 2 years ago? Well, we all know what happened 2 years ago. The coronavirus pandemic happened, and basically the EFG was used as the foundation for a lot of the government's guarantee scheme. So the EFG flipped into a number of different schemes in terms of what was there, and it became basically a bit of a lifeboat for providing capital and making sure that the people with the capital and the lenders didn't again do what they did post financial crisis. So it allowed liquidity to flow into the sector. And so you've got various flavors of this stuff, but effectively where we are now is we've had the most generous set of public policy guarantees that we've ever seen. And there's effectively a contingent liability on the government's balance sheet of about up to 70 billion in terms of what's there. In terms of the various guarantee schemes that have been around since coronavirus. Now, to put that in context, previously we've roughly had that at about 300 million a year in terms of since the early 80s, roughly, depending on how you sort of count some of that stuff. And so to have 70 billion at one point in time, there's a different level of systemic risk in terms of where we are now. Now, actually, for us, that period of time was a really useful one to say, well, what's the potential of guarantee schemes for the social investment sector, for social enterprises, for charities? And again, some of the stuff that we did involved SIB and using some of their skills, expertise, and how they can connect to organisations on the ground. And so that was a hugely helpful piece. But where Treasury is up to at the moment is they're going, right, we can't continually have 70 billion outstanding at any one point in time in terms of things that might go wrong. What do we think around shaping the future of this? Do we just revert back to an EFG? Do we look at the whole thing again? I'll come into sort of some of that process when we're there. For us, as we look at our social lending work as a mains, this is sort of the third point in terms of where our strategy is going. We're trying to effectively work on both sides of that bridge. So we're trying to help more organizations who have capital find the matching transactions in the middle that work for the kind of mandate that they have and the risk return and impact appetite that they have. And we're also trying to allow as many organizations as possible get access to that, as so many of you have talked about. And without that thing happening, I don't think we can be successful. Now, we see guarantees as one of the enabling functions to allow us to do some of that stuff, particularly with the evidence from what we were doing with CDFIs, and we continue to do with CDFIs under the EFG and now the latest guarantee scheme, but also as we've started to see it work through the coronavirus pandemic, through some of the work that SIB are doing and others around how this can be of benefit to social enterprises and charities as well. And it's great to Andrew to see some of that stuff come out in the Commission's work around some of that stuff as well. And that's part of why we're having this conversation today as well, because we want some of that stuff and how some of that stuff has been can work for both of those groups, both investor and also social enterprise and charity, to feed into our recommendation and our work shaping what the Treasury recommends is coming next. So where they're up to currently is they have put a consultation out to all of the providers of the current guarantee scheme. They're getting all of that information back, and as part of that, we're doing some of that stuff. Responsible Finance, who looks after the CDFIs, are doing some of that stuff, and we're coordinating a little bit with them. And they are looking to make a sort of a decision on what comes next. And when I say what comes next, the current guarantee scheme, which is called the Recovery Loan Scheme, which Rob will talk to you about in a little while in terms of its terms and how it's currently designed and some of those sorts of things, comes to an end at the end of June. And they're looking at what comes next in the future to help meet some of the gaps in the market. And to be honest, from their point of view, I think everything and nothing could be on the table. They are coming at it from a certain perspective, and we just want to make sure that as they change some of this stuff, that they learn some of the lessons and have some of the evidence of how it could be most valuable to the social economy, to social enterprises, charities, and other organisations. And so with that, I'm going to pause and hopefully hand over to Rob if all the technology keeps working. And we can dive into any of those points in due course, and Rob will hopefully bring some of that stuff to life and also correct anything that I've managed to botch and get wrong. Rob.
Thanks, James. No, that's I think you got it all right, so I don't think there's anything. I thought, that was a good summary. I like the bridge analogy, and I think it's helpful to also for everyone to understand why having this session today and getting the feedback is important, because you've got meetings with Treasury and British Business Bank coming up next week, almost to put the case of our sector to to them to try and continue providing guarantees to our sector, and hopefully I can show with some live examples why I think that's important from the experience we've had. Olivia, is it possible to? I've just got a couple of slides, so is it possible to share? Oh no, wait a minute. Have I got sharing rights?
Just bear with me.
Yeah, you should have sharing rights, Rob.
Oh, yeah,
I can
have.
share on my
Okay.
side if there are any issues.
Can you see my screen? Cool.
Yeah, all good.
If someone does have a question, then I just shout, because I can't see all of you on screen while I'm doing this. But so just a bit of background. I'm Director of Investments at Social Investment Business, and led the setup and deployment of a 25 million resilience and recovery loan fund, which was guarantee backed through the pandemic. So what I'm going to talk about is a bit. I'll try and simplify the guarantee a bit from a lender perspective, and then also talk about how that translates across to what that comes out to look like for customers and who it can help. And then I think that should become more apparent at the end. I'll give some key sort of case studies of real customers we work with, which I think helps to bring this to life, because some of this stuff is technical, although I'm going to try and keep it at a high level. So I think, first of all, I think, there's different groups on here. Some of you are lenders. So I think what I've got here is just trying, in some ways, the guarantee is a very simple instrument, actually. If you look on the left hand side of the screen, there's a diagram or infographic which explains the guarantee, and actually there aren't really many bits to it. The bottom half is actually just a lender doing loans to a borrower and then paying capital interest back. So that's all the same. I think that the two key bits are really that the British Business Bank, underpinned by the government here in the UK, is providing a guarantee where the lender can claim a portion of the outstanding credit losses of the loan, 70% in this case at the current time. But I think the other important bit to be aware of is the government actually doesn't give the lender that guarantee instrument to use completely for free. The lender actually has to pay a lender fee, which is a percentage. It's a bit like an interest rate. It's a per annum percentage on the outstanding guaranteed loans. But that does, when I'll come on to it in a minute, that does make a big difference to how lenders may look to use the guarantee, is understanding that, yeah, we do. And actually, it's wrongly called sometimes a first loss guarantee. Even the British Business Bank use that term, but actually the guarantee itself is risk sharing. So it's a partial loss. So in the case of the recovery loan scheme at the moment, what happens is a lender such as SIB, when a customer's unable to repay a loan, we can claim a portion of that loan that goes bad back from the British Business Bank. At the moment, that's 70%. But the other 30%, us as a lender, we take that hit, we lose that money. So if we lend £1 million out, just to say one customer, we can, and it all goes bad, we can reclaim £700,000, which is material, but we still take a 30% hit as a lender. So, and in addition to the cost of, so that's a 30%, that's a cost to us as a lender in real money terms. But then there's that additional cost that we have to pay as a lender for the scheme lender fee, which currently is reduced for the social lenders to 1%, but for private lenders, it's around 2%. And that was actually a big win as part of the guarantee schemes, that they recognised that social lenders should pay less because we're having a different type of impact. But what does all that mean in terms of, for a lender, where does the guarantee then really come into play, or really have a benefit for lending different types of organisations? And it only really works when lending to organisations that they can still afford to repay a loan. I mean, that's critical. This isn't a grant, it is repayable funding, but they don't really have sufficient collateral to support a loan. So they don't have tangible assets such as land, property, equipment. Because if they do, the lender can actually take that security, probably recover more than the 30% they would lose under the guarantee, and plus the cost of paying the guarantee fee would outweigh the benefit of having it. So actually, if you were to use the guarantee to try to fund property loans, it would cost more to you as the lender through credit losses and paying for the guarantee than the benefit you would get from the claims under it. So I've tried to keep that fairly high level, but what that does mean is really the guarantee can be used to lend to organisations, unsecured or lightly secured, and using the guarantee as the sort of collateral rather than an asset. So you can think of lots of organisations in the charity and social enterprise sector that are service business models that don't have tangible assets. So it really comes into play in our sector. I think some people referred to previous guarantee schemes, James and Jed and others, where they have existed for 30 years, but a real game changer in the last 2 years for our sector, and one we lobbied hard for during CBILS, was that the British Business Bank changed one key eligibility criteria, which was they made charities exempt from having to have more than 50% of income coming from trading. So when CBILS was launched at the beginning of the pandemic, and we opened a fund for it, all the charities that contacted us, we told, you are not eligible because more than 50% of your income doesn't come from trading income, it comes from donations and grants. And we and others, and I'm not sure who made them change it, but lobbied to say, you know, there's plenty of charities that need funding, and we'll see some at the end. That needs to change, otherwise, you know, you're making them exempt from this group. And they did change that, which then meant we could ring back all those charities that contacted us and said, ignore what we said 4 weeks ago. You are now eligible. Sorry, the rules of the game have changed, and I suppose that is something key that needs to be maintained in guarantees going forwards. But otherwise, we weren't able to support charities. So that's a big game changer. Although these guarantees have been around, getting government to recognise that. And I think it comes back to your point, James, about feeding back and having a voice as the sector, because they didn't intentionally factor out charities. I think they were putting it there to factor out people using the guarantee to fund R&D or non-viable trading businesses and jobs. They didn't put it there to factor out charities, but there was no voice in the past saying we should be using these instruments in our sector. So part of this session today is mobilizing that voice, I suppose. I'm not going to go into boring detail, but basically behind the scenes, also as a lender, there is some bureaucratic operational procedures and systems. I mean, for most lenders, they will be worth doing in our space, bearing with that. But there are, you know, we have to enter the loans into Business British Bank systems, so duplicating processes. There's lots of paperwork behind the scenes with claims. The British Business Bank audit you annually using one of the big four. There's legal contracts. None of that is to put people off lenders using it, but there is an operational cost as well to using the scheme that needs to be borne in mind if you're running this. And it does have some criteria. I mean, I know someone said earlier about patient capital. Currently, the RLS guarantee has a maximum loan term of 6 years. That's probably, I mean, you can refinance loans things, but that is the maximum at the moment that's mandated under the scheme. And then I wanted to move on really and talk more from the borrower perspective. And I'm not with guarantees, but I've worked in organisations where we've been borrowing, as a social enterprise, where we've been borrowing money. So I have been on both sides of this fence, an investor and a borrower, actually, in the social sector. But one of the key things, that's probably why I put it in big bold stuff, is just to make clear to everyone. The guarantee is provided to the lender, as I showed you previously. It's not provided to the borrower. And so it doesn't remove any of the borrower's liability for repaying the loan. The borrower actually remains 100% liable for the debt. And why do I put that in big bold letters? It's because for me, the biggest concern I have, and I always tell my team that this is around mis-selling of loans. There's been plenty of mis-selling in the financial services industry. What is clear, we don't want to do loans where the customer thinks, oh, if I can't pay it back, the government's going to pay my loan for me, or it's going to guarantee me, so I can ring up and say, oh, I'm only liable for 30% of the loan. That is not true. They are liable for 100% of the loan. The guarantee is not for the borrower. And so it's absolutely critical that the relationship managers go through with potential borrowers this fact, so that someone doesn't later down the line and go say, well, I didn't understand. I thought I was getting a loan. I thought I was only liable for 30% of it. So that's why I put that in big bold, because that's absolutely critical, that throughout, from the borrower-lender relationship, that is always clear. But I suppose that then, if you're a borrower, you probably go, well, but then if I don't directly benefit from the guarantee, well, what use is this to me? It's just benefiting the lenders and the funders. They're getting reward or money back from this, but I'm not. I'm still liable for the loan, which is an absolutely valid question. And so the answer really is, the lender is obliged by the British Business Bank to pass on the economic benefits of the guarantee to the borrower. Now, I'm not going to name any names of lenders commercially, but that did not always happen in the pandemic. There, as with lots of things that were private commercial lenders, even some contacted me to say, how many times are you refinancing borrowers in the same year to claim more fees from the government? And I said, well, I'm not doing that. So all of these things can be open to abuse, but the spirit of the scheme and what BBB are increasingly monitoring is that the economic benefits of the guarantee are passed on to the borrower, and that can take several forms. So the first one is lending to organisations that can afford to repay a loan but lack sufficient collateral. So again, I'll evidence that at the end with some specific examples, but really we're talking about organisations, they don't have land, equipment or property. They still need funding for their organisation. And particularly a lender would find it very difficult to lend a certain size of loan or term of loan without that security. And this guarantee is enabling you to lend to organisations that wouldn't otherwise be possible. So you'd probably say, I cannot lend to that organisation, or I cannot lend them 100 grand. I can only lend them £20,000. You know, I can't give them what they need. So the guarantee is to change that aspect, and used properly, it really can do that. So I'll come on to examples. And then the second way those economics are also can be passed on is in reduced costs. So you're saving costs of bad debts, and also potentially lower costs of capital. So everything else being equal, James talked about it earlier, it may make lending or investors, if you're trying to raise capital like SIB have been, willing to reduce the interest rate they're lending to you at, with everything else being equal. So you can have a risky organization or whatever. It's then saying, right, I can actually potentially lend to that organization. It's still affordable to them repay, but they don't have collateral, or otherwise it'd be too risky. And I can do so at a price or an interest rate that is affordable or reasonable to them. The key point to make is that it's not saying that a guaranteed loan will always be the cheapest source of financing for an organization, because you still got to borrow cost of capital, you still got to pay the guarantee fee. So it may be quite likely, if you're going to get a commercial mortgage against a property, it is going to be cheaper for you than a guarantee-backed loan. But a guarantee-backed loan would either make it possible for someone to lend to you that couldn't, or it would be cheaper than, if it's a 7% loan, if they really had to charge the risk without the guarantee, it would have been 14% or something like that. So it's changing the price, or it's changing who you can lend to, but it doesn't mean a guarantee-backed loan will always be the cheapest source of financing for that organisation. And then I'm keen to sort of finish off really by bringing that to life with a couple of examples from the last 12 months. I suppose there were two real ones that really stuck in my head, and there was a lot of organisations we were talking to. One was the first loan we did through the Resilience and Recovery Loan Fund with the guarantee, which was to the Royal Society of Blind Children. It was very uncertain times. This was an unsecured loan of £250,000, so that they needed, and the need had arisen because the cancellation of the London Marathon. They had 50 runners in the London Marathon, and yes, there are 50 runners in the London Marathon, which equated to about £250,000 in income they lost overnight. So quite dramatic source of income. And then actually, when they first contacted us, as I said, we said, well, you're not eligible for the guarantee, because this historic rule for the last 20 years that your trading income is not over 50%. Most of it is from grants and donations. Doesn't matter that you've shown for the last 50 years you can generate income in that way. You're not eligible. So we originally had to tell them they're not eligible, and then a few weeks later call them back and say, actually, no, you are now. We can use guarantee schemes for charities, and actually we can support you with £250,000 unsecured loan, even in a risky situation of the pandemic where future income was less visible. We thought it was viable, and we're able to take, that level of risk with them. I think a second one was Gingerbread, the national charity for single parents. And probably this hit home personally because although I'm not a single parent, I just had identical twin girls during the pandemic when setting up the fund, and so was juggling parental life, but luckily with my wife, not on my own. And Gingerbread contacted us, and they were getting 10 times as many calls from single parents who were in the pandemic. and they were only able to answer 30% of those calls. So 70% of the calls from single parents that were calling them for support could not get hold of anyone on the line. And thinking of those people that, were trying to look after children, maybe juggling jobs on their own, isolated, quite at home. And we were able to, again, a lot of their income had dropped off from fundraising and other things, but we were able to give them a £300,000 loan to employ 10 people immediately to be able to answer phones and offer that support. And quite simply, if it wasn't for the guarantee, lending £300,000 unsecured, haven't got any assets, uncertain income environment, even though these are fairly well-known organisations, we did lend to smaller ones as well, we simply wouldn't have been able to support them, and their banks weren't able to support them either. Even with guarantees, often they weren't supporting charities and social enterprises. So it did make a big difference to organisations like this. There's a quote there just underneath that says, that's from Autism Plus. Again, we funded them £500,000, and it meant they could continue providing those services when people really needed it. So I think that hopefully that feeds through to showing how, understanding a bit about how the guarantee works, where it can be used, where and how actually it can make a big difference to end organisations, to fill gaps, particularly in the sort of unsecured finance space, and make it affordable for organisations to borrow. I think I'm just going to hand over to, we have a video which you'll know well, Alan. I know you're from WCVA, who we worked with. So we worked with WCVA to support St John's Ambulance Cymru in Wales during the pandemic, again with a large unsecured loan. But if you could play that video, and then maybe we can take it to discussion or questions, Mel.
For us to be able to do what we do, we need the equipment, we need the training, and having that really does make a difference. It gives us much more confidence. It also means that we can provide the best level of support and care that we can.
The investment allowed us to play a really significant role in supporting the people, communities of Wales and the NHS at a time of unprecedented crisis. We were really preventing serious situations deteriorating into huge emergencies.
Social impact and investment really helped us during a really difficult period last year. We had a significant impact due to the pandemic, with restricted activities around our training and our sort of volunteer activities at that time, and that also had an impact on our cash availability. It sort of filled that cash gap really during that period of time. The Resilience and Recovery Loan Fund is very similar really to the coronavirus business interruption loan scheme. It sort of bought us some time longer term, where we could see where we are at the end of that period, to see if we want to continue utilising that loan or pay it off.
We've been working in the vaccination centres around Wales, supporting the NHS to ensure that the country is vaccinated as quickly as possible, and the pandemic can be put behind us as soon as possible.
Without the equipment and the support that we've had, we really wouldn't have been able to deliver the support that we've given to the vaccination programme. It's been a privilege, it's been hard work, but we really did enjoy participating and helping our communities to get the vaccines when they needed it.
Social lending as a tool is really important for a charity like St John Ambulance Cymru, and the big difference between a social lender and that of a sort of normal corporate commercial lender is the criteria that is applied. So the social impact is a key consideration for a social lender, whereas in the commercial world it tends to be more focused on profitability, EBITDA, shareholder return, and that's not sort of our core function really as a charity. It's really important to have that as a consideration from a lending perspective for somebody such as ourselves, alongside obviously the availability or the sustainability of our business model to repay the loan that's been made available to us. It's also to understand that we're there for not just profitability alone.
Follow on from that in that although we managed to deploy all of the funding, 25 million of loan and 4 million from accessing grants, we didn't manage to get everything right. And one of the key areas that we struggled with was to get funding, particularly to BAME-led organisations across the UK. Although we had quite a lot of applications from these organisations, a lot of them didn't make it all the way through to getting approved for funding. And so we collected a lot of data. It's shared transparently. You can see it online on our website, where the different drop-offs of that occurred. A lot of it was at the beginning. A lot of organisations simply weren't large enough for the turnover of the size of the organisation we were looking to fund through the scheme. But there were other aspects as well that they didn't get through to funding. And so, I mean, I know Dave's here from Fusion 21, but particularly working with them, we've launched a successor fund called the Recovery Loan Fund with them as a founding investor. And we're actually now working in partnership with Ubele Initiative and Create Equity with some access money, really to what we found is a lot of those organisations have been underinvested in, and so didn't fit the usual criteria to meet for the fund. So what we're doing is working with those organisations, Ubele and Create Equity, and using some grant and support money to change that, as well as changing some of the fund criteria to make those organisations as eligible more often. So that is a work in progress. I think it helps to respond to the Adebioli report, but yeah, so we didn't get everything right, and we're looking to make sure there's more equitable use of funding, and that these guarantees can provide finance on a wider and more diverse base. But yeah, sorry, I just wanted to finish on that.